please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Upasna Bhardwaj was with us a short while ago. Upasna, so the government acting, 5 measures being announced. What do you make of them and the impact? Specifically, of course, as I pointed out, the current account deficit is the big macro concern that the government is hoping to address.
Yes, clearly, Shireen, I think some of these measures would definitely provide, or rather reduce the pressure on the current account deficit or rather financing of the current account deficit right away. And I think the 6th point which the finance minister mentioned was, which we still will be awaiting clarity on through various ministries, is how they would be curbing the non-essential imports. So we'll have to wait for those, because on a structural basis, I think that is a bigger move. More on the short term, yes, the ECB's within 1 year, the withholding tax reduction of 5% is to be reviewed. I think all of this clearly in the short run should be slightly positive for rupee. I think one more thing which I would like to highlight is that in the presentation which the governor made to the FM, apparently it was mentioned that the inflation remains well within the moderate range. And if that is what is presented, then probably, it clearly suggests that, maybe the possibility of a rate hike or an immediate reaction to the currency fall with a rate hike is diminished. On that account, if at this point, if the governor believes that inflation remains in a moderate range. And another point here, I would say, is that the government does seem serious about trying to meet their fiscal targets. So while, yes, there are risks, because, yes, while there may be risks because of the revenue shortfall here and there, but I believe that the emphasis on trying to control current account deficit and the fiscal deficit is clearly coming out from, the FM speech. So somewhere it is about providing the comfort to the markets that the government is there to act as and when required, and that should be slightly positive for the markets when they open on Monday.
Right. Upasna, as you pointed out, current account deficit clearly the big concern that the government is hoping to address. But just on some of the specific measures that have been announced today, when you talk about this mandatory hedging conditions for infrastructure loans, which they say will be reviewed, and this, of course, comes under the ambit of the ECBs, manufacturing entities will be allowed to access ECBs of up to $50 million for the maturity of a year, removal of the exposure limit of 20% of FPIs corporate bond portfolio to a single corporate group, and 50% of any issue of corporate bond will be reviewed. I mean, on balance, these specific measures that have been announced, what do you make of them?
Yes, I think, like I said, right now, there is an issue of a widening current account deficit. The other bigger issue is, given the global uncertainties, how to finance that widening current account deficit. And that's where I think the focus has been, by exempting the Masala bonds with the withholding tax of 5%, that is very positive. The ECB's, the tenor being tweaked to 1 year, that again, I believe, even the hedging strategy for the infrastructure, I think that itself would probably reduce the immediate dollar demand, as and when it's happening. So somewhere, and of course, not to mention the corporate bond limit, which was really becoming a big constraint for the inflows within the corporate bond segment. So each of these are very minutely, each of these issues have been picked up at a micro level, the issues which are plaguing each of these segments, and hence this should incrementally be positive in terms of capital flows. So to an extent, this does provide some respite in terms of financing of the current account deficit. So I would like to say that, because it's more on the current account deficit, which is a structural issue, and that easing is yet to be announced. The measures on that bit is yet to be announced. So it's more on the financing of the current account deficit, wherein I think that is slightly positive. It does provide scope for some more incremental inflows.
Right. Upasana, I'd request you to hold on. We've also got Shoumyakanti Ghosh with us and also Lata. Let me go across to Shoumya first. Shoumya, thanks very much for joining us. 5 measures, specific measures being announced by the government this evening. What do you make of them? What do you expect the markets to make of these measures when we open for trade on Monday? And more importantly, it's very, very clear now that the #1 concern for the government is the current account deficit, and the ammunition is now being fired by the government to tackle that problem singularly.
No, I think these are, I haven't gone through the measures, but as I understand from the conversation which you are having, I think the measures which the government has announced was more or less expected, because tweaking of the ECB norms, tweaking of the norms of the Masala bonds, this has been the demands of the market for a long time, and I think rationalization of the ECB norms will also help the corporates to see if they can tap the external market. So that will actually reduce the pressure on the domestic market in terms of the liquidity issues. So that is one thing. The other thing, I think the Masala bonds withholding tax, that is also a very important step which the government has taken. And I think all these steps are to boost capital inflows into the country. So that is point #1. The second thing which I would like to highlight is that I think there could be more measures which would be, which now is the domain of the RBI, that could be unveiled in the next week. And these, together with the measures of the RBI and the government, will go a long way in having a sobering impact on the rupee-dollar rate.
5 minutes. We are live right now. Shireen is anchoring.
Right. Shoumya, on specifically the point that Upasana also picked up on, and I wanted to go back to just that, on the presentation that's been made by the Reserve Bank Governor, which the FM alluded to, suggesting that the inflation, according to the Reserve Bank at this point in time, was moderate. So where does that leave you now with the possibility of action come the October policy?
See, I think the RBI policy, that's actually still an open-ended question, because I still believe that the global markets are volatile, and given the impact of the US-China trade war, the extent, so that is, I still keep that open, that monetary policy decision is October, but a lot of this will also depend on how the exchange rate behaves in the next couple of days. Maybe it is appreciates, then the RBI may take a considered view of all the factors, but my sense is that in a scenario when the exchange rate has been under pressure, and even though India is an inflation targeting country.
Okay, we've also got Pranab Sen with us. Mr. Sen, thanks very much for joining us. You believe that the government would hold its fire, but they have announced 5 specific measures today in the first installment and said that more are likely to follow. What do you make of the measures announced, sir?
Well, it's not so much the measures. I am a little worried about the message that's going out from the government, because what it suggests is the government is deeply worried, and that would be just about the last thing that I would want to project at this point of time. So I am, what should I say, both surprised and disheartened by what has happened. The relaxation on the ECB time limits, for instance, is something which we have resisted for many, many years. And now to reduce the time limit to 1 year is extremely worrying. Now, in a situation like this, where the market then gets the sense that the government is sensing a crisis, becomes a self-fulfilling prophecy. And that's something that I think should have been avoided at all costs.